Welcome everyone. Thank you for joining us. This is another episode of our MarFinance series. Today we'll be talking about customer lifetime value and its application in growth strategy. With the regime shift from growth at any cost to path to profitability, I've seen many marketing teams in the last, let's say, two to 3 years get fewer resources even after being successful in driving way more results with less. I believe this is strongly connected with the fact that marketing and finance usually speak different languages. With this purpose, MarFinance aims to equip growth practitioners with frameworks and tools to align a common language with finance, influence the boardroom, and secure resources for long-term sustained growth. Today, we'll be talking about customer lifetime value, its basic applications, its basic definitions, its applications in the context of growth and marketing, and finally, one of my favorite applications, customer-based corporate valuation. To do this, I have the pleasure of sharing the screen with two of my heroes in the quest of connecting the dots between marketing and finance. First, we have Peter Fader. He's the co-founder and director of Theta Equities. And Francis and Peyon Chia, professor of marketing at the Wharton School of University. He's considered one of the world's foremost experts in the development and application of customer lifetime value. There are free books out there. I strongly recommend the audience to read them. Customer Centricity, the Customer Centricity Playbook, the Customer-Based Audit. And he's the co-creator, together with Dan, and we'll go into a second into Dan's bio, of customer-based corporate evaluation, which is one of my favorite methodologies to value both subscription and non-subscription type of companies. And prior to Theta, he and Dan co-founded Zodiac, a predictive customer analytics firm, which was acquired by Nike in 2018. We also have Dan. Dan is the co-founder and director of Theta and associate professor of marketing at the Robert H. Smith School of Business in the University of Maryland. He's the co-creator as well, as I mentioned, of the customer-based customer evaluation, company-based customer evaluation methodology, and has won a number of Academy Awards, including an MSI from the Marketing Science Institute. He has also been featured in many media outlets and academic journals, including Harvard Business Review. There's a seminar article written together with Peter, which is I strongly recommend it. Wall Street Journal, Financial Times. I know that both of you have created some hype around some IPOs in the 2019, 2020, 2021. He also holds a PhD in statistics from the Wharton School of University and graduated with both degrees in economics and system science engineering from Wharton and University of Pennsylvania. Last, I will be moderating this panel. I'm Pedro. I'm the Chief Business Officer at Winclap. For those that are not familiar with our brand, we help brands like Wellhub, Mercado Libre, Didi, Rappi, Avenue, Globo to transform the growth strategy. In other words, to transform their acquisition, retention, and monetization strategies from multiple solutions, including growth consultancy, paid and owned media management, creator-based content for performance, market services. In other words, we combined consultancy firm with an agency. We call this category growth transformation. With all the proper introductions being done, please the audience, you will see there's a QR code at the right. Please scan it and fill the questionnaire. It's a very simple one question questionnaire that we will share the results at the end. But I think it will give us a lot of a glimpse in how the audience is doing today, the topics we're going to touch. So with this, we will kick it off. We have three sections. The first one has to do with customer lifetime value and the basics, then the applications, and finally customer-based corporate evaluation. Before that, I want to ask both of you, what was your motivation? What triggered to put a lot of focus in your careers in customer lifetime value?
Well, I'll jump in first since I've been doing it just a little bit longer, not necessarily better than that. For me, I like numbers. I like data. I like to predict things. So whether it's sports statistics, whether it's movement of songs through the popularity charts, I've just always been interested in just tracking things and seeing where they're going to go next and how far for how long. And there's a lot of different domains where you can do that. You can do it with Wall Street. You can do it with an insurance company. So many different areas. And it was while I was an undergraduate math major at the Massachusetts Institute of Technology, MIT, where one professor came to me and said, "You ought to get a PhD in marketing." And I thought she was crazy because, again, this was early 1980s. But she painted a picture of what marketing would become. She was exactly right. The ability to tag and track customers and to start asking these questions about how long are they going to stay with you and how often are they going to buy and how much are they going to spend. So it was just a natural fit with my interests. And she was right that it's an area where there's tremendous opportunity, new data sources, new decisions to be made, new ways to evaluate those decisions. So for me, it's been just an amazing ride to help observe a lot of the changes in marketing and to some extent to create them, to push companies to be more data oriented and customer centric. So customer lifetime value is just a natural consequence of that. It's just bringing together so many different kinds of predictions into one, and to do that over a long range and to do it with very important consequences. So that's where I'm coming from. I've been messing around with it for a long time. And then it was an absolute pleasure when this young PhD student, Dan McCarthy, walked into my office just about 10 years ago.
Mm-hmm. What's your story, Dan? How did you decide to come into Peter's office and start investing a lot of your energy and time in this topic?
Yeah, it started, I was a straight up kind of Wall Street guy coming out of Wharton for undergrad. And I was pricing rainbow swaptions and all sorts of crazy financial derivatives. And then, more broadly speaking, fundamental analysis as well. So I ended up spending a bunch of years working for a hedge fund before coming back for the PhD. And it was in the second year of the PhD that another Dan had recommended that I should chat with Pete Fader, this guy up on the 7th floor. I think he had to cross like a dual listing in both departments. But I went up there and kind of the rest is history. We started working on one project. Actually, that project ended up not converting into anything publication worthy, but really got me interested in the general idea of predicting what customers will do. And then it was really kind of connecting that with my prior background, where I'd spent all these years thinking about, what will revenue be? What are the free cash flows going to be? How can we use that to understand whether they're, a company we're looking at is undervalued or overvalued? And it's like, the revenues come from customers making purchases. There had been some, early work from within the marketing literature that tries to tie those two things together, but it was, like a sum the customer lifetime values sort of a thing, as opposed to actually thinking about it as people in finance do. So that was really what we quickly gravitated to. And it was shortly after that we kind of had this first paper on subscription-based, customer-based corporate valuation come out. And then, we had the second one. So then that became such a fun topic to study, but it was kind of interesting how we got there.
Which I agree. It's a really fun topic to study and work. For me, it's probably one of my passions of what I do here at Winclap as well. Investing time on helping clients and our customers understand how their companies are projecting, and then being able to influence maybe a little bit just in that trajectory. It's really, really both fulfilling and fun, like really doing the stuff. So let's jump in then. Let's jump straight into it. Let's start with a simple question, or maybe it's a hard question. What is CLV, customer lifetime value?
Dan, you have a clearer, more precise definition than me. Go for it.
No, I don't know about that, but we have gone on the record a lot about this. It's basically the net present value of the variable profitability of a customer. taking into account all of the relevant costs and profits associated with the customer. So how much you spent to acquire the customer in the first place, and then all of the variable profits and costs that happen thereafter until the customer ends the relationship. And so, so one of the key things then is that we want to be very careful about what expenses we include and which ones we exclude. The costs that we want to include are everything that go into the revenue that's being generated. So, if you're a widget seller, you want to make sure that you're accounting for all of the costs associated with the manufacturing of the widget, labor and materials, but also everything else that that you have to incur as a cost to bring that revenue in. And so, so things like the CEO's salary probably you wouldn't want to include that because you bring in that next order, you're still going to have the CEO. So there's a lot of costs that do not scale with with that next incremental order. And I think that's what leads to some of the issues is there are all these questions that come up as to, well, there's this cost. We know it doesn't go up with the next order, but maybe if the company was 25% bigger, you're going to have some more of that cost. And so it kind of falls into this gray zone. And I think that's where we spend a lot of our time is thinking about, exactly how should we divvy up this expense into, fixed versus variable and that sort of thing. The other big thing that it highlights is, well, how much did we spend to acquire that customer? And that is an awfully difficult question to answer. So I think that there's easy answers, there's directionally correct answers, and then we try to get better and better from there. But conceptually speaking, what it should represent is how much money had been spent to bring in that customer in the first place. So you would want to take into account things like, what's the acquisition channel they came in through? Was there anything that we did differently for that one? It's typically shouldn't be a one-size-fits-all number that applies to to every single acquired customer.
And if I can add, I love not only Dan's definition, but the way he elaborates on it. If you listen to what he said, it's not all just about revenue. We have to care just as much about the cost. It really is about profitability. If you look at a lot of even my older work, when we started laying these models out, it was overwhelmingly focused on revenue alone. Because you know what? Projecting revenue, how long is the customer going to stay with us and how often they're going to buy? That's all the stuff I love to do. Whereas trying to project and understand costs, less interesting, less sexy. It's less about kind of math and more about accounting. But if we as marketers want to build the bridge to finance and accounting, we have to care as much about that stuff. And we have to be as clear and careful and respectful of those kinds of details as we are about the revenue-oriented ones. And that's where Dan McCarthy has really raised the conversation, where it's not just about doing a little bit more math. It's about changing the way we talk about this stuff, the inputs and the outputs.
You're here. And the discount rate, it doesn't have to be 10%.
I was going to ask about that. Before we jump into the discount rate, I know that both of you teach different courses related to the topic. And when you describe CLV, it sounds simple. I take a customer, I figure out how many profits this customer is going to generate over a long period of time, and the period of time I can kind of foresee. I take into consideration all the costs that I incur to either serve directly this customer and acquire these customers. And there it is. I have CLV, I have the post-acquisition value, and I have the CAC. But at the same time, I have heard you in different outlets that in your courses, you spend at least one lecture just to talk about CLV. So there's something there looks very simple on one side, but on the other side, it seems that it's not that simple. Why is that? What are the things that companies usually get wrong or don't assign the enough weight?
So let me start with a few, and I'm sure Dan will have many more to add. Of course, he laid out some of the issues. Is just what inputs do we bring into the CLV analysis? But one of the problems when we talk about the CLV analysis is it implies that there's a formula. There's a specific kind of approach, and very often, if you read a white paper, or you see someone talk about it, say, here's the way to do CLV, as if there's one formula, one approach for every business. That's clearly not true. And you said at the very beginning that there's this distinction between a subscription model versus something that's more discretionary and there's no contract. And there's lots of subtleties beyond that. So I often go around talking about the 6 fundamental business models, and even that's not enough. There's just so much complexity. And it's not about the kind of thing that the company sells. It's about the nature of the relationship. Do we observe when the relationship ends, or is there what we call latent attrition? Do revenue generating activities occur in a regular manner, or are they kind of more chaotic? Do the spend levels stay steady or vary over time? So there's just much more subtlety to it. And you said it yourself, Pedro, that people think about customer lifetime value as a simple concept. And it's kind of our job, not so much to complicate it, but to make it realistic, to have people identify some of the challenges in talking about it, and therefore some of the challenges in implementing it. So that's why there can be plenty of conceptual and technical complexity. That's just for starters. I'm sure Dan has more to add.
Mm-hmm. Yeah, just a few others that we'll often see. So there's a whole bunch of ways that people will kind of do it incorrectly. There's the revenue only way of computing CLV, which we kind of alluded to with that whole discussion about costs. This is the divide by the churn rate way of computing CLV, which represents multiple flaws. For one, it's probably grouping together a whole bunch of customers, and for two, it implies a retention curve that doesn't tend to play out in the data. So you never want to be computing CLV by taking something and dividing it by a churn rate. Yes, Pete was alluding to individual level versus more aggregate level, or even overall customer base level CLV. Ideally, you really want to make sure to do it at the individual level. You want to take into account when different customers were acquired, and do it at least at the level of the cohort. One other thing that will often come up is you'll see companies not apply any discount rate. And you think about that and you say, oh, come on, you're just talking about trifles. Well, in Peloton's pre-IPO prospectus, and then there was another company called Aspiration Financial, the lack of a discount rate led to them kind of overstating CLV by a factor of like 2 or 3. And that's because at the time, the churn rates were very low over the first few years of the customers that they had acquired. And so they used this formula that ended up implying that, tons and tons of the customers will still be alive and paying their fees 30 years, 50 years, even 100 years into the future. And that's where a discount rate really matters, because if you don't apply a discount rate, that cash flow 100 years from now is worth just as much as one that's going to happen a month from now. And as soon as you start even applying even a trivial discount rate, the cash flow 100 years from now is worth almost nothing. So so you can end up with these very dramatic swings. And so it's kind of not a surprise that oftentimes we find the companies that don't apply a discount rate, they're doing it intentionally. That you have the most potential to kind of inflate the implied numbers. So yes, I can go on and on and on. It kind of begs this next question of, well, how far out do we go in the CLV calculation? And I think ideally it should be as far out as we can, because ultimately all that cash flow is coming to you from the customer. And so if it is, then we want to be able to credit the customer for all that value. I think there's all sorts of problems that can happen, though, if you have a very, very young company, it's only been around for a couple of years. Do we really feel confident about a projection, 10, 15 years into the future for them? So, it's not easy. And that's why I think just having perspective from having done so many of these, I think that can be really helpful in coming to the best answer that we can.
Summarizing, we're talking about profits versus revenue as a first thing we want to project, then look at least cohort data and not just historical averages, especially when looking at churn rates. We want to make sure there's a discount rate. When I read your Peloton post and I read about that there was no discount rate. I was like, what the hell? Like, how is that even possible? But I imagine there are a lot of conversations around it. But yeah, we want to make sure the audience can understand the concept of discount rate and be sure to include it. And lastly, have enough data to foresee, to project the future. That takes me to the next topic, the next question. And the audience, we have wide heterogeneity of the type of businesses and the type of companies and stage of the companies. I have two questions that I get asked a lot, which are, is there a correct time to start, the right moment to start computing or working on CLV? And second, is it for every company, or there is any type of business which this doesn't apply?
Go ahead, Dan.
Yeah, good questions. I think, so there was actually this piece that I had kind of looked over the shoulder of someone, his name is Rodrigo Fernandez. And what he was basically suggesting is, even if you don't have any historical transaction data, it's very helpful to start thinking about what the unit economics of your business will be. When you think about growth planning and having a sustainable business model, you have control over your pricing. You've probably got a decent sense of what the margins are now and what they could be in the future. You probably have benchmarks for how you can think about what reasonable average, below average, above average retention or purchase frequency might be, depending on the category that you're in and how good of a job you can do. So yeah, you can start to back your way into what the economics of the business would be if you were to kind of get it going. And I think that sort of exercise can be tremendously valuable, even in the absence of transactional data. Now, obviously, we have the most fun when we actually have the transactional data and we can start running the models and making predictions and replacing assumptions with just directly observable historical behavior. But I think I would contend that this is the sort of thing that you should be doing from day one, even before you have any data. It's just that the nature of the analysis that you'll be able to do is going to vary over time. In terms of the business models, I think there are certain business, we'll often say, the main two constraints that you'll often run into are, for one, can you actually observe the end customer? And if you can't, then you can run into trouble. So examples of this could be a B2B2C, where for whatever reason you don't have access to the transaction behavior of the end customer. So it could be someone like Hershey's or some other CPG company, and depending on the business that they're in, they may not be able to tag and track the same customer across the different channels that the customer might be buying Hershey's through. So so I think that's kind of one big one. The other one is, even if you have good trackable customer data, if you have 10 customers, then it's still going to be pretty hard. You would really need to know exactly what those 10 customers are going to do. And so there's kind of a minimum size requirement that we'll often say that, at least for our sort of models, we need to find the patterns across the customers. And so it helps to have at least, not even that big, but at least a cohort that is somewhat comparable of 200 customers, maybe 500 customers, that we can kind of pull together. And for most B2C businesses, that shouldn't be an issue, but you can imagine for either some super tiny businesses, or oftentimes in B2B SaaS, they'll have ginormous customers, CPG as well, actually, if you're selling the pickles, and Walmart is the major customer that you sell through. You can see it happen over there.
And I just want to add a bit, agree completely with the second point, some of the limitations of companies that will just have a hard time getting the data or leveraging the models. On the first point, when should you be using it? Let's say you have plenty of data and so on. I believe it or not, I worry a bit about companies trying to leverage CLV a little bit too early. They should be doing the calculations. They should be developing the discipline, the muscles to be able to continue to update those calculations and to start thinking about what to do with it. But early on for a company, for a true startup, it's all about product market fit. It's all about, let's get this product out there. When we're talking to our investors, we often talk about the ICP, the ideal customer profile. Most companies don't have a clue about that. They're making it up. And so it's often important to be kind of casting a very broad net to try to bring in as many folks as possible and to start to then understand who really are the best customers. Obviously, lifetime value is going to be good for that. But if companies start doing it too early and they get this early, maybe misleading sense, oh, our best customers come from this geography or this industry, they might be missing even better ones. Or they might be having a mistaken impression even about those best ones, because sometimes those early cohorts are not representative of the later ones. So do the calculations. Again, develop all the capabilities early on, but don't overemphasize it until acquisition growth starts to slow down. So there's a just right balance there.
I would agree.
That's an interesting point, Pete. We talk a lot about companies we usually work with companies that are post product market fit. For exactly that same reason, pre-product market fit is very hard to really understand what is the customer lifetime value of your customers, because you're still figuring out who are your customers. So it's an excellent point to mention. Before we move into the use cases.
Yeah, just on that. I think the question is when to start doing the calculations.
Yes.
The growth planning, I would contend, is still pretty helpful because you may have, we've got a company, we kind of have this one segment, like there's very clear, distinct segments, and they each have different unique strengths and weaknesses. And I find myself thinking about the goodness of those segments through the lens of CLV, even though we've never really done a whole lot of the calculations ourselves, I think for some of the reasons that we've been alluding to. Yeah, I think that framework can be helpful, but I agree, the actually running calculations and just tripling down on the segments that, look good in terms of historicals is, that could be very dangerous early on.
And to your point, Dan, doing at least modeling the growth planning, how would it look like, and kind of like thinking ahead of what this business needs to look like to be profitable over time is a really strong exercise to be doing, even if you don't have product market fit. I would say I wouldn't recommend the companies to start making decisions based on CLV before product market fit, but they're definitely like thinking ahead of how this business is going to turn a profit over time. And there are like most business models are out there. I wouldn't say all of them, but there are a lot of business models that already exist. So I imagine that you can look at existing companies, not necessarily the same vertical, but how do actually they work, and use that as well to complement and think ahead if you're not having product market fit yet, how you can turn a profit. So before we jump into applications of CLV, we're in very interesting economic times. All markets are kind of anticipating rate cuts either this year or next year, but soon. I want to ask you, how do marketers think about or should think about the impact of changes in the cost of capital in their CLV? Like, should they anticipate for that? Should they include it? Is it something that needs to be part of the conversation, or should be don't even care about it and just continue with a standard discount rate?
Yeah, it's a good question. And I think, again, this goes, how can we make CLV a useful, usable concept? And I think to a lot of people, the discount rate is something of a theoretical construct. But the idea is, imagine that you are a company that has access to the capital markets and you were to borrow money to be able to then funnel into customer acquisition. What is the rate of return that's being demanded by the capital provider? That is a very relevant cost of capital to use in the CLV calculation, because it literally represents the rate that you have to pay on the money to the borrower, to the lender, to be able to acquire the customer. So I think absolutely, to the extent that cost is going down, then it lowers the hurdle rate, the kind of the required rate of return that you would need to justify, getting that money, shelling it out on customer acquisition. And so even if you did have a whole bunch of cash in the bank, if you knew that tapping the capital markets would require you to pay a certain rate, then that's probably a very reasonable rate to use when you're doing your discounting. And that can swing as a function of rate cuts.
This is such a good example, such a great answer. Dan made a comment very early on about some of the very old work before we started getting into it, where people just calculate lifetime value, just add it up and say, that's it, that's the value of the company, not taking into account just anything on cost of capital or just access to capital. They're basically saying, we're marketers, we don't worry about that. We're just going to look at the customers, we're going to let the finance and accounting people worry about it. The problem is when you do that, you lose complete credibility. The recommendations that you make, the way you evaluate your strategies, it's going to be way, way, way off. So it's very important for marketers to take that course and really pay attention to it on finance and accounting, if for no other reason, just to be able to have an intelligent conversation and to avoid saying stupid things. There's already some skepticism about marketing. And maybe the marketers. And so it's really important for us as marketers to know what's going on in the capital markets, to think very carefully about how that's going to impact the kinds of marketing decisions that we're making, and to participate in that conversation and not walk away from it saying your problem. And so that's why I love the whole MarFinance thing. We really want to not just build a bridge between the two areas, but combine them together. Which means that we have to really do our homework much more than we've done before.
Yeah,
we really need to do. Sorry, Dan.
There's this person who's commenting, we just released this post about CLV for PE. And on Twitter, we were posting about it. And there was one person who had chimed in, I think, I won't say mockingly, but it's kind of, this is just a way to help some VCs dump some overvalued IPO shares. It was something along those lines. And I would say that is the sentiment amongst a pretty decent number of people, that it's just this kind of made up marketing material that doesn't have a whole lot of credibility. And I think that's really what we're trying to change. I think that there's a lot of incentives from companies to, again, be like Peloton. I hate to keep bagging on Peloton here, but just do whatever it takes to make the numbers look good, because they don't want to look bad. So they want nice big CLVs, they want really small CACs. And so what's the incentive? Take all the costs out of the CAC calculation, remove the discount rate, go off of revenue, whatever it takes to kind of make the numbers look good, remove all the non-cash expenses, do whatever it takes to have the numbers look great. But then you end up with these numbers that no one believes. And so what good did it do you? And I think that's done a disservice to the whole CLV world. And so I think having someone come in who's third-party arm's length, just trying to get the right numbers, I think that can go a really long way to actually, show people how valuable these numbers and metrics can actually be when they're used and calculated correctly.
And if I want to, just a minute ago, I was kind of dumping on the marketers, saying we got to do our homework and pay attention to finance and accounting. But it really does go both ways. Like the Peloton example is such a good one. Keeping in mind, that wasn't just an ad. That wasn't just some marketing talk. This was in documents filed with the Securities and Exchange Commission for the company to go public. There are no standards. There are no rules about what you can't report, how you would calculate different kinds of things like customer lifetime value or customer retention. So Dan and I are going to the finance community and accounting community saying, if you're going to talk about this stuff, here are the words, here are the metrics, here are the narrative you should wrap around it. And they basically ignore it. They basically say it's not our problem. So it really does go both ways. The Peloton example, which by no means is unique, there's plenty of others like it. It's appalling that these kinds of things are going on, and that financial regulators just ignore it.
Going into there and moving into the next section, I totally agree that it's both finance and marketing homework. I think in the last 2 years and a half, kind of the burden of proof moved from finance to marketing. So now marketing needs to explain stuff, needs to convince people. I think like pre-2022 was the other way around. So marketers, we could, in a way, escape those tough questions. Now there's no choice. And as I said at the beginning, the whole motivation of the MarFinance series is we have seen a lot of brands, now marketing teams, really like sharpening their pencils, doing the right kind of work, proving they're right, but still getting less budget, less resources, in a way that it could be damaging the companies in the long run. And I truly believe that the main reason for that is we need to do a better work to explain like what do we do and how do we drive growth, and how marketing is actually a growth driver and not a cost expense in the company. Now, let's assume for a second that the companies have the right CLV models. They've done their homework, they have the right calculations in place, which I've come across companies that really do a good job doing that. How can actually they apply this into the day-to-day decision-making of their marketing and growth teams? How does CLV inform their acquisition and retention strategy? And which are the main use cases over there?
Well, you said it yourself. It's acquisition, retention, and development. What we like to call the building blocks of customer centricity. Now, those words aren't new. Every company is doing those three things: acquiring new customers, trying to hold on to them, trying to make them more valuable while they're with them. But the way that those activities take place, the level in the organization, and the accountability or lack thereof around the performance of those activities is still pretty poor. You look at a lot of companies, and when it comes to marketing spend allocations, it's all about brand versus performance.
Yes.
And we have nothing against brand. Branding is very important, but in many ways, branding is not an end unto itself. Spending on a brand doesn't do anything directly. All the action occurs through, here we go again, acquiring customers, having them stay with you longer, and being more valuable when they're with you. So in some sense, brand serves these building blocks, helps you do those things more effectively, more efficiently. So what we're trying to do is to get companies to elevate these tactics, acquisition, retention, development, have them done at a higher level in the organization, create more visibility, not only within marketing, but make sure that the accounting, finance, and even supply chain, everyone is interested in them. Have them sync up with each other. Too often you have the acquisition people here and the retention people over there, and they're not talking, and there's problems there. So conceptually, it's not that hard to elevate the kinds of tactics that really do a great job of leveraging and showcasing customer lifetime value. It's a big cultural, organizational change more than a technical challenge, and that takes a lot of time.
Mm-hmm. Then there's the other kind of acquisition related tactics. So yeah, you can start thinking about what we can do to make things better in terms of acquisition and retention. And being instrumented for action becomes very helpful. We'll often start, this was, again, Pete and I, we co-founded a company called Zodiac before co-founding Theta. And at Zodiac, the bread and butter was really helping customer acquisition. It's not that this couldn't be used for customer retention, but I think that it's a little easier on the acquisition side. And the idea is that you have different channels. They have different costs, and they acquire customers that have different value. And so if you can kind of get really good estimates of the costs and the value after acquisition across each of those channels over time, that can help you understand how well different channels are performing, and that can help you then reallocate budget towards better performing channels away from lesser performing channels. But I think that whole idea of slicing and dicing your business on the basis of segments, I think that same analogy holds. So it doesn't have to be Facebook versus Google versus TikTok. It could also be different business units. It could be different geographies, salespeople, you name it. If it's something that is really important and you could potentially shift strategy on the basis of it, it could be helpful to see how those different basically how your unit economics vary across those different things to decide where to prioritize your business.
Yeah, there's a great question in the chat talking about how we can get our CMO and CEO and CFO to move away from focusing on purely on quantity, the obsession over CAC, to focus on value instead. This is where the emphasis on lifetime value comes in. Again, putting aside what you might do with it, if we can make customer lifetime value as visible, as visceral, as tangible as the cost of acquisition, if we can have a balanced perspective when it comes to evaluating our acquisition activities, instead of focusing on cost minimization, how do we acquire as many customers as cheaply as possible, to value maximization, are we bringing in lots of potential value through the right kinds of customers? Again, conceptually, very, very easy. But operationally, to get people to shift that focus instead of looking down and minimizing costs to looking up and maximizing value, very, very challenging. And even the smartest of companies have a hard time doing that.
Mm-hmm.
Is that a cultural problem? Is that a cultural problem in the companies? It's an incentives problem. Or is it actually hard to do technically? What do you think?
It's easy to do technically. It's very easy. It's all about culture and incentives. You're exactly right. We are not culture people. We're kind of quant guys, but we have growing an ever greater appreciation of that cultural element. How do we start the conversation? What experiments should we push them towards? What other analogies and metaphors can we come up with to get people just to look at things and organize in a different way?
Mm-hmm. Yeah, we've been speaking with this one public company that the person who had headed the division, he's now moved on, but he was a firm believer in this way of looking at the world. But you get that email from your boss's boss saying, we're missing our number, we need to acquire this many active customers and we're not there yet. So what do? You can't ignore your boss's boss. So I do think that that cultural element, oftentimes it leads its way into incentive compensation. You're going to do what makes you money too. And so you may think that some other strategy may be better, but if that doesn't get you paid or potentially even, could get you fired, if you just disregard your boss's advice, then you're not going to do that. So I think, and I think that's honestly one thing when I first started doing this, I was just, I'm an investor type. I want to think about this from their perspective. I think that is one of the benefits of customer-based corporate valuation is now, you start talking about which email to send to which person, the CEO and the CFO's eyes are going to glaze over. They're just not interested oftentimes. But if you talk about this is what your valuation is going to be, they're very interested. So we're often speaking with heads of investor relations and the CFO specifically for those types of considerations. So it kind of is this Trojan horse where we can kind of open that door and get people thinking about, oh, well, maybe we really should be thinking about our business and about value creation in this way. But without that hook, I think it can be challenging.
So Dan, you introduced the topic of customer-based corporate valuation. Of course, we cannot have a conversation with the two of you without talking about it. I will start by reading a quote from your HBR article, which when I was reviewing it for this webinar, I found something that is very, very, very compelling. And it says, the quote says the following: using customer metrics to assess a firm's underlying value, a process our research has popularized, is called customer-based corporate valuation. This approach is driving a meaningful shift away from the common but dangerous mindset of growth at all costs toward revenue durability and unit economics, and bringing a much higher degree of precision, accountability, and diagnostic value to the new loyalty economy. What struck me from the quote, this is dated February and March 2020. Just like 12 to 15 months before the bubble that we have all seen in digital economy at the end of 2020 to 2021. So my first question before jump right into these methodologies, do you ever think about like how many billions in funding could have been saved if more investors and companies alike would have embraced this methodology before, or at least think about it?
You can, yeah, it's kind of hard, but yeah, it was funny back then. We were doing these IPOs that Pete was alluding to, and you kind of run the numbers on this company and on this company, on this one. And at the time, we found that a lot of our implied valuations came in under the IPO valuation. Not always. And so, Slack and Revolve were notable exceptions, but oftentimes they did. And so then the question becomes, who's wrong? And at the time, we did find there was a decent number of people who were basically saying that we were wrong because there's this other X factor, that we're not including in our valuation that's leading us to be systematically pessimistic. But I think, again, the way that things have unfolded, hopefully it is somewhat of a vindication for us and for those numbers.
And today it's almost the opposite problem. There's
the opposite, right?
A lot of private equity firms sitting on a lot of dry powder. There's actually some pretty good values out there, but now they're kind of just too shy to go out and take the risks that they would have done routinely just a couple of years ago. So the pendulum swings. And one of the nice things about this approach is it just brings stability, it brings rationality. And it kind of can really help not only, make more money, find some of that alpha, as the finance people like to say, but to really reduce some of the volatility, to reduce that herd mentality, that this kind of sector, this kind of business model is cool, and now it's not. Just to be able to look at things, just do they have good customers or not? Period.
Mm-hmm.
So, what is customer-based corporate valuation? How do you find it?
Yeah, it's just basically explicitly tying the activity of customers to the overall valuation of a firm. And actually, this speaks to one of the questions in the chat about how do you connect CLV to the P&L? And it's basically this, that you could think of this matrix where every row is a customer and every column is a time point. And the cells represent the number of orders that you get, the amount of spend that you earn, the amount of contribution profit that you get from those customers. And if you think about what CLV is, it's kind of looking at the rows of that matrix. Mm-hmm. It's saying, let's do this discounting to get the value for each customer. And if you think about what finance people tend to do, is they tend to sum the columns for revenue and for variable profit. And if you sum up all the revenue across the customers, that has to give you total revenue within those slices of time. And so really what we're trying to predict is our models, they predict the entire matrix. And so that matrix can give you the CLVs, but then for the finance people, it can also give you the period by period revenue and then ultimately cash flow projections. And so that's really how we connect this with the P&L is predict the matrix, and it gives you everything else for free. You just have to sum up something or the other.
Another way to think about it is that people think about revenue as a thing, as an entity, as something tangible. We say it's not. Revenue is just the composite of how many customers have we acquired, how many rows have we added to that table, how long do they stay, how often do they interact, how much profit do we make when they do. And so decomposing revenue into those components and understanding them, projecting them, and then adding them up is going to help you project revenue or cash flow or EBITDA over a longer horizon with more accuracy and with a better diagnostic understanding. Well, why are sales plateauing? Is it because we're not acquiring as many customers, they're not staying as long, they're not buying as often? So it really, it's as Dan likes to say, I'm stealing his words, it's an accounting identity. It's irresponsible not to look at this decomposition of revenue if you want to maintain your fiduciary responsibilities to your stakeholders.
Mm-hmm. So we'll often say CBCV as a framework can't be wrong. It has to be right. If you believe, the main primitive is, do you believe that the value of a company comes from future cash flow? If we can't agree on that, then then we can't get started. But as soon as you start believing that, then here you have this accounting identity that gives you what the cash flows are going to be. And so that has to be right. Our predictive model may be inaccurate. We may make a prediction in February of 2020 and then COVID hits or something, but we want to distinguish between the framework and the predictive model, that's fit on historical data.
What are the building blocks? Let's say I want to start tomorrow. I'm the CMO of a company, VP of growth. Where do I start to build this? How do I start?
Customer base audit. I would start historical and then worry about the predictions. I think that oftentimes, obviously, we've kind of broken it down. You've got acquisition, you've got retention activity, you've got repeat purchases, you've got spend and variable profit, and those are kind of the main drivers of a model like this. So those are what we're looking for. So I think step number one would be, I guess, first an appreciation of that, but then second would be, let's just look at what those numbers were in the past. And let's look at them by segment. Let's look at them, obviously, by cohort, by channel, et cetera, et cetera. So I think that will give you an understanding of, where the data has been so far. And then the predictive model will allow you to then project that into the future and then use that understanding to help, understand valuation and, which segments to prioritize. But starting historical, I think, can be very clarifying. The other nice thing is, if you start historical, it's easier potentially to get buy-in from the executive team because you don't have to make any assumptions about what will happen in the future. Again, they're going to be skeptical. They haven't been looking at the world this way. And so if you can say, this is just what the numbers were, there's no model here, this is just the truth, then oftentimes you can have this wow moment that you can get that would be a little harder to get to if you were to layer in a whole bunch of heroic assumptions that lead to projections over some horizon into the future.
Well, I appreciate the shout out, Dan. So again, my third book is the customer base audit, and besides the fact that it is the natural foundation to then build the predictive models, it is, from a cultural standpoint, a great way to get that buy-in. That we're gonna open up, we're gonna be totally accountable, we're gonna do this boring customer base audit just to see what's going on and how does it compare this quarter to last quarter, so we can see if there's anything going on with the company that we should take action on. So it's just a nice way to send that signal to others in the organization that it's not just about executing tactics, it's not just about all the fancy marketing stuff, it's about just understanding kind of the lifeblood of the organization through the lens and at the level that everyone should care about. So it's a natural starting point to both drive the tactics as well as to, create MarFinance.
When you say that you present the customer base audit, or even going forward to predictive models, that companies have been seeing their business in a different way. What are those different ways that you usually find? What do you encounter in those first conversations when they see your work or they see a customer base audit for the first time? Like, what were they looking at before?
That's cool. So and this is why it's beautiful that if we do it on historical data, so there's no arguments about what model to use. There's no arguments about the discount rate or anything like that. It's all data that we can agree on. And then we start to look at whether it's the difference across the cohorts, the fact that the more recent cohorts are much less valuable than the ones that came before them. Or we start slicing and dicing on the basis of channel of acquisition or products that were purchased in their first order. I mean, there's a great example. We have a whole chapter on that in the customer base audit. Let's line up all of our products from the best sellers to the worst sellers. And we tend to focus so much on those best-selling products. Obvious. Turns out that in many cases, those best-selling products are purchased by relatively unprofitable customers. A bunch of people who come once, buy the popular thing, and never buy from us again. Whereas way further down the list, there are going to be some products, and we don't sell a lot of them, but my goodness, if we look at the profitability of the customers who buy them, wow. So it lets us shine lights on the operational things that we do to see where is the value, not just the volume. And it gives us kind of immediate advice about what kinds of tactics to take.
The other thing is we found a lot of the companies that we work with, it's not like you just snap your finger and you got your CAC data and cohorted data. Typically it involves a lot of work, and some companies are already mature and they already have that, but oftentimes they're not. And so there's kind of this first preliminary step then that it actually gives us the right data to train our models on. And so you kind of need to do that anyways first. So might as well start there. I'd say the other thing that has been pretty effective has been to start with charts that show this model-free evidence of the vast heterogeneity in the value of the customers. And sometimes I think managers, they may not appreciate just how much of the value that they're getting or how much of the revenue that they're earning is coming from this super small percent of the base. But the right charts can really show you that. And you just take a cohort of people, line up all your customers sorted, and then just look at, what percent of my revenue am I getting from the top X percent of my customers? Some chart like that. I think that can be pretty striking, just be something that they had never seen before.
Unfortunately, we're heading towards the end. We're running out of time. I could speak about this all day long. I don't want to end without putting the two of you in the shoes of our audience, which I imagine there are a lot of CMOs, VP of growth, growth directors that have to deal in the day-to-day with both convincing influence in finance and at the same time trying to change the mentality. So you will have to give advice, let's say to me, to sit with my CFO or my board or executive team. And what advice would you give me to start first, how to approach the conversation or the conversation that I need to start and start changing the mentality? And second, really start to work to incorporate CLV into the day-to-day of my teams.
What do you think, Dan?
Yeah, I think it can depend. We're the ultimate, well, I don't know if to call it one-trick pony, but my default position would be to find some way to get the CEO and the CFO to be interested. And so I think to the extent that we can kind of win them over with descriptives that show something very striking about customer base and the value, I think that could be a very good entry point and allow for that cultural transformation to go much faster than it otherwise would. So I think that would probably be where I would start. Again, for the business in particular, it's going to vary what would be the most salient for them. Presumably it's going to be something that they hadn't thought of before. So it's going to depend on the financials of the business. But I think starting there is going to probably make it more likely that we would actually see the company move in that direction than if we were to start with someone from a different position.
It's interesting how our conversation has changed over the 10 years since Dan walked into my office, and all we talk about would be models and forecasts and technical things. And now we're spending so much time talking about culture. I'll talk for myself, naively used to think that if I could just give you this CLV magic wand and you could wave it over each customer's head and see their projected value, that you would just know what to do and money would come raining down from the sky. And we realized that's kind of naive. It's actually much more complicated than that. And in fact, you don't want to jump right into the models because there'll be all these questions about technical things and discount rates, which matter, but kind of miss the point. So a lot of it is to get people on board with the fact that, hey, your customer is really different from each other. You need to understand that all the value is in that long tail. So let's understand what makes them different. So start with kind of broad qualitative things that are very easy to verify, relatively easy to act on, and then make others want to do the CLV thing. Those right tail customers are terrific. How much more are they worth? Well, I just happen to have the tools for you. We want them to come ask us about CLV. The burden is on us to make them, start asking those questions and requesting the kinds of models that we'd like to run all day long.
Some people say that our role as marketers at the end of the day is create demand. So at the end, what you're both saying is they create the internal demand for finance and our teams to come to us to ask these kind of questions. Gentlemen, this has been a pleasure. Thank you a lot for your time and your recent insights today. To the audience, thank you all for joining us. We will be sharing the recording briefly, and hopefully this is the first of many conversations in the MarFinance series with both of you. Have a great day, everyone.
Thank you.
Take care.